Earnings forecasts. A company's earnings are a wonderful indicator of its performance. And AI businesses that consistently and steadily increase their earnings should be seen favorably. Earnings growth will be a key factor for many investors, as many AI companies will be perceived as growth stocks. The movement of AI stocks is usually abrupt when earnings are released. Important narrative information about the firm's operations is provided by annual reports, and the financial statements let you examine the debt-to-equity ratio and other accounting ratios that the company uses to help you decide which stocks to buy. Comparing a stock's performance to that of an index or another stock is known as relative performance versus the market. It is best to compare the relative success of younger AI businesses with those of similar companies. Growth analysis examines how a business has expanded over time. To ascertain the company's strength and future prospects, you'll look at earnings, market share, and other data. In 2024, investing in AI presents attractive opportunities for portfolio inclusion. The media, healthcare, automotive, finance, and other industries are just a few of the industries where technology is still gaining ground. But you'll also have to deal with obstacles like possible changes to laws and regulations, shortages of supplies, and larger ethical and political issues around the widespread use of AI systems and the environmental implications of their power. If you want to profit from the AI explosion while minimizing dangers, you'll need to keep informed and invest wisely in businesses that prioritize strong business models. If you're just starting out, the thought of investing may be scary, yet it's crucial to wealth creation and saving for a variety of financial objectives. Throughout your investing career, you'll come across a wide range of market conditions, so don't get too caught up in whether or not this is the ideal moment to start. However, it's critical for novice investors to understand their level of risk tolerance before making any investments. There are investments that are riskier than others, and you don't want to be caught off guard after you've committed. Consider how long you can live without the money you plan to invest and whether a few years or more without access to it is okay. For individuals who are just starting off, here are some excellent investing options. Before we dive in, hit that subscribe button and press the bell icon for more informative videos like this. Number 6. High-yield savings accounts. One of the easiest methods to increase your money's return over what you would get from a regular checking account is to do this. While still allowing regular access to funds, high-yield savings accounts, which are frequently opened through an internet bank, generally offer higher interest rates than conventional savings accounts. Additionally, online banks can be a terrific location to lodge money you're saving for a purchase in the coming years or merely holding in case of an emergency, with some of the best rates and years available on high-yield savings accounts. Number 5. Certificates of deposit, CDs. Although they may tie up your money longer than a high-yield savings account, certificates of deposit, CDs, offer an extra approach to increase the interest on your savings. A CD can be purchased for a variety of durations, including 6 months, a year, or even 5 years. However, usually there is a penalty if you try to withdraw the money before the CD matures. These are regarded as being quite safe, and you are covered up to $250,000 per depositor, per ownership type, if you buy one through a bank that is federally insured. Number 4. 401k, or another workplace retirement plan. With some significant benefits that may help you both now and down the road, this may be one of the easiest methods to begin investing. The majority of firms offer to match a percentage of your agreed-upon retirement savings from your regular income. You are passing up free money if your employer offers a match and you don't take advantage of the opportunity. Contributions to a standard 401k are paid before taxes are applied, and the funds grow tax-free until retirement. Contributions to Roth 401k are permitted after taxes and are provided by some employers. You won't have to pay taxes on your retirement withdrawals if you choose this option, because they allow you to invest consistently over time and are automatic after you make your first selections. These workplace retirement plans are excellent savings tools. Frequently, target date mutual funds provide another option for investing. These funds manage their portfolios in accordance with a predetermined retirement date. The fund's allocation will change away from riskier assets as the goal date approaches in order to accommodate a shorter investment horizon. Number 3. Investment mutual funds. Mutual funds allow investors to purchase a variety of stocks, bonds, and other assets that they might find difficult to accumulate individually. The most widely used mutual funds follow indexes like the S&P 500, which is made up of about 500 of the biggest American corporations. Investors in index funds typically pay very low costs, or sometimes no fees at all. These cheap fees allow investors to retain a larger portion of the fund profits, which can be a wonderful way to accumulate money over time. Number 2. Exchange-traded funds, ETFs. While they hold a basket of securities, ETFs fluctuate like stocks do throughout the day. This makes them comparable to mutual funds. Unlike mutual funds, which usually have a several $1,000 minimum investment requirement, exchange-traded funds, ETFs, have no such restriction. ETFs can be bought for one share plus any applicable costs or commissions. And if your broker permits fractional share investing, you can start with even less. In tax-advantaged accounts such as 401(k) and IRAs, mutual funds, and exchange-traded funds, ETFs are excellent investments. Number 1. Individual stocks. The riskiest investment strategy covered here is purchasing individual company stocks, which can also be among the most lucrative. However, you should think about whether purchasing a stock makes sense for you before you begin trading. Consider whether you are investing for the long run, which is usually 5 years or more, and whether you are familiar with the industry you are getting into. Because stocks are valued every second of the trading day, individual stock owners are frequently tempted to adopt a short-term trading mindset. However, a stock represents a portion of ownership in a legitimate company, and when the underlying business's value increases, so too will your own. If you don't think you have the knowledge or fortitude to stick with individual companies, think about using mutual funds or exchange-traded funds, ETFs, for a more diversified strategy. Why should you begin making investments? Maintaining the purchase power of your money and achieving long-term financial objectives, such as accumulating wealth or retiring, depend heavily on investing. The value of your hard-earned money will eventually decline due to inflation if you allow your funds to sit in a standard bank account and receive little or no interest. You may ensure that your savings keep up with or even exceed inflation by making investments in assets like stocks and bonds. Short-term investments can help you earn more on your savings while you work toward a major purchase like a car or a down payment on a house. Examples of these investments are money market mutual funds and high-yield savings accounts. While stocks and exchange-traded funds, ETFs, carry more risk, they are seen to be better for long-term objectives like retirement since they are more likely to generate higher returns over time. Crucial factors to take into account for novice investors. Risk tolerance. You should be aware of your personal risk tolerance before you begin investing. When volatile investments like stocks decline, some people may become highly uncomfortable, which could lead you to sell at the worst possible time. Selecting the right investments for you will be made easier if you are aware of your risk tolerance. Monetary objectives determine the long and short-term objectives you hope to accomplish with investing and saving. A sound plan will be developed by you if you know what your investment goals are, either inactive or alert. Additionally, you must choose between being an active and passive investor. An active investor may select individual stocks or mutual funds with the goal of outperforming the market, whereas a passive investor usually holds an asset such as low-fee, diversified mutual funds, or exchange-traded funds, ETFs. According to studies, over time, passive investing typically performs better than active investing. Attempt it yourself or employ help. Alternatively, you can use an online broker to handle your own assets, or you can get assistance from a financial advisor, sometimes known as a robo-advisor. If you do it yourself, the charges will probably be reduced. But for individuals who are just starting out, an advisor can be useful. Taxes. You will probably have to pay taxes on interest, dividends, and capital gains if you have investments in an individual or joint account. If you have investments in tax-advantaged retirement accounts, such an IRA, you can avoid paying these taxes. How much cash is required before making an investment? The good news is that you can begin investing with a small amount of money. The majority of online brokers don't require an account minimum to get started, and some even allow small investors to start with fractional shares. ETFs that let you assemble a diverse stock portfolio can be bought for a few dollars. If you want to start investing, you can even round up debit card purchases on micro-investment platforms. When making an investment, especially if you're just getting started in the world of investing, be sure to take your financial goals and risk tolerance into account. Certain investments, such as high-yield savings accounts, enable instant access to funds in case of emergency. Conversely, equities ought to ideally be a component of a long-term investment strategy. A lot of first-time investors also use robo-advisors, where an algorithm picks and maintains an exchange-traded fund portfolio for them based on their unique risk tolerance and financial needs. If you learned anything from this video, then don't forget to like this video and subscribe to our channel. See you in the next video. Thanks for watching.